Morning, good afternoon, good evening, wherever you are in the world, especially good evening to Professor Li, who joins us from Beijing. I'm Nicolas Véron. It's my pleasure to introduce this new session of the financial statement series. As some of you may have noted, and as I announced nearly a month ago, we were scheduled to have a session 2 weeks ago on the implications of Brexit for UK financial regulations, but that was cut short by the announcement of the new election because the Bank of England officials who were scheduled to speak are not allowed to speak in public during election campaigns. So nothing we could do about that. But now we're delighted to debate what governments can do to promote venture capital in their jurisdictions, the good, the bad, and the ugly ideas. And we're very grateful to both Professor Li Bo and Daniel Gros for being speakers on this topic. Professor Li studied at University of Western Ontario in Canada and at University of British Columbia, where she got a master's degree in economics in 2006, and then on to a PhD degree in economics from Queen's University in Kingston, Ontario in 2013. Since coming back to China the year after that, he has been in the faculty of Tsinghua University in Beijing at the PBC School of Finance, which has been created jointly by Tsinghua University and the People's Bank of China for about 10 years. And then since last year, 2023, at the Guanghua School of Management at Peking University, which we see in her background. She studies bankruptcy law, industrial policy, anti-corruption actions of the Chinese government, and of course, venture capital, which will be our topic today. Now, of course, the US is the biggest country when it comes to venture capital, so you would imagine a second speaker from the US, but for a comparative perspective, actually, we came to the conclusion that it was more interesting to have a speaker from Europe, because Europe and China are in a way comparable spaces in terms of trying to develop their own venture capital industry, where in the US, that development has, the early development has taken place very long ago. So I'm very grateful to Daniel Gros for being the second speaker today. Daniel and I have to disclose, go back a long way. He studied at the University of Rome, where he got a degree in economics and business, and then at the University of Chicago, where he got his PhD in economics in 1984. He worked at the International Monetary Fund for a couple of years, then joined CEP, the Center for European Policy Studies in Brussels, went back to public life at what is now DG ECFIN, the Director General for Economic and Monetary Affairs at the European Commission, where he was a senior advisor in the late 80s. And since 1990 until 2 years ago, he has worked at CEP, the Center for European Policy Studies in Brussels, which of course was an early inspiration for Bruegel, my other employer, and of which he has been the director for 20 years, from 2000 to 2020. Daniel also has private sector experience. He has been chairman of an asset management firm in Italy, which was initially San Paolo IMI Asset Management, and vice chairman of Horizon Asset Management, which succeeded San Paolo IMI AM, all that between the mid-2000s and the mid-2010s, I think. He has extensive experience in advising senior policymakers in Europe and elsewhere. He has been among many other advisory positions at the Advisory Scientific Council of the European Systemic Risk Board until 2020, and has so many contributions to EU financial, monetary, and economic policies that I will not even try to summarize them. With that, Bo, over to you.
Great, thank you so much. It's a great honor to be here. And then, let me first share my slides. Right, so can you see my screen? Okay, great. Thank you so much. It's a great honor to share some of my recent research on the VC industry in China. So after I come back to China in 2013, so I've been always interested in some new trends in China, especially on VC investment. So this is one of the ongoing research. So we published last year with my great co-author, Emmanuel Colinani from Chicago Booth and Ernest Liu from Princeton. So essentially in this paper, we call that investing with government, a field experiment in China. So I will start from my academic research. So at the end of my presentation, I'll move more towards the policy implications, especially on China's industrial policies. Okay, first, to motivate the VC investment in China. So overall, I will summarize that government participation is pervasive in China's planned economy. So for instance, I show in this figure, so both in number of funds as well as the trillion dollar of yuan, so it has been rising since 2013, and has been declining after then. So this is consistent, I remember, with one of the Josh presentation on the rise and fall of the VC market in China. So essentially, the state is shaping significantly about the the world's one of the largest startups in China. So then the question is, so given the active investment by the government, so then in the academic literature, we try to debate about state capitalism or specialty regime and whether it's grounded with the complementarities with between the private capital versus government capital. So given government is a big player in this market. So on the right panel also it shows the percentage share of the government investment in the VC. So especially in terms of both governments, LGFV, government-guided local government financing vehicles, as well as government-guided funds, so which is one of the biggest fundraising in China. So both of these considered over about exceeding 30% in terms of its funding. So now this just is a conservative estimate in terms of direct ownership. But if we are counting this kind of indirect ownership, so the percentage will be even larger. All right. So speaking about VC and PE industry in China, so the concept is kind of blurry. So usually it refers to early stage investment. So in terms of the size of VCP industry in China is massive. So it reached 1.6 trillion by 2020. So most of these are RMB funds today. So and also it used to be like government only prior to 2000. But in the recent past 2 decades, so we are also observe increasing participation by these traditional financial institutions, founder funds, investment companies, high net worth individuals, banks, trusts, or insured funds. So they have been active investors in this sector. So now what I refer to as government is to include different entities, for example, central government, provincial government, local government agencies, as well as state-owned enterprises. So these players are very active in this VC sector. So essentially, these government entities, so they can act both as the GPs as well as LPs. So GPs is what we refer to as venture capitalists. LPs mainly provide funding for the VCs. And also, especially government-guided funds. So this is very unique feature in China. So they provide funding to these kind of VCs, which subsequently will invest in the startups. So we think about if government serve as LP, so provide funding. So typically, they are act as passive investors. But however, there are different narratives about the role played by the government in the VC investment. For example, there could be pros in terms of government connections. So, you want government regulatory approval, so this can deliver local benefits in terms of taxation or access to certain information, which is important in China. But also, there are downside in terms of the cons. For example, so when I started this project, so I think we conducted quite some face-to-face interview with these kind of VCs as well as startup. So we asked them, so what are the pros and what are cons? And some of these questions especially result about cons associated with government funding, especially related to the political interference. So for example, it could be investment restrictions on where these funds should be allocated, only in certain regions or only in certain industries, such as semiconductors. And these funds often focus on short term. So meaning probably they need to exit within 5 years. And also, in addition, so these kind of government-guided funds, so they can be exposed to local policy uncertainties given the government politician rotation and etc. So therefore, we're curious about to learn, especially from the industry practitioners, what could be the pros and cons, guide us to thinking through. So whether should you invest with government? So it motivates our research quite a lot. Now here, so before I show you some of key results, so we would like to show you some starlight effect. So number one, so government is a leading VCP investor in this industry. So it consumes about half of these LPs. And then also government is a minority owner of a significant share of these VCP fund managers. And then furthermore, surprisingly, so government-owned funds manager, they perform worse than their private counterparts. So despite we cannot draw too much conclusions about, so they could have been, have their social values. So that can explain their worst performance. So there could be different reasons. And then also we show that there is a assorted matching. So as government LPs, so they are more likely to invest more with government-owned fund managers. So these are our starlight facts. So from our admin data. And here, so it comes with our research question in this paper. So essentially, so our paper is one of these first research on the VCP market in China. So if previously I showed you about LP and GP, so here it probably shows you more clearly about what I refer to. So investors who provide funds, so it could be government LPs or private LPs, who subsequently invest in these VCP firms. So we call them as GPs. So they could be government or private GPs. We subsequently invest in these kind of startups. So in academic literature, so there's a lot of research on the VC and the startup, but there's a limited research related to the LP and GPs matching, especially we think about the role of government. So that's why we try to look at these research questions about the role of government in the VCP market. Now, specifically, we try to ask the question, do market participants, do they value government participation? So this is a fundamental question. We think it's very important, especially on the efficiency implications as well as on the future government policies. Should the government participate in the VCP investment? And then so what we do in this paper, first we construct administrative micro level data on VCP firms. So what we did is we collect these kind of from data from zero to IPO. We form a partnership collaboration with zero to IPO, and then so we obtain the admin data on VCP deals, and then we match each of these LP, GP, and the startups. And then furthermore, we match this data with business registration in order to identify the government ownership, especially on the percentage. So this allows to precisely measure the government ownership in terms of how many percentage of the government ownership. And then so the second piece of research is try to use we conduct a field experiment. So what we did is we conduct a large scale, so consisting of survey of over 1,000 GPs and LPs. With illicit preference for these investment partners in an incentivized real setting. So this is this consume most of these kind of active and large VC and PE in the market. So we are able to learn about their response, their preference on government money. And the last part of our paper is we try to construct a two-sided search and matching model to discuss what will be the equilibrium impact associated with government participation. So if we would double the government money, what will be the equilibrium impact? So, how should we, so this can give implications on the future government policies in VCP market. So this is a summary of our paper in case I run out of time. Okay, so why do we need an experiment? I'll be very short. So in terms of academic research,
for brevity, I'm sorry because I'm mindful of time. I suggest you skip a lot of the methodology and move to results and implications.
Great, thank you. Yeah. Okay, so here's our main finding. So let me summarize. So in addition to the previous what I showed on the starlight effect, so what we find is average GPs, they dislike government LP. So this is very surprising. So we tried, but however, LPs, they prefer GPs who already have a government LP as investor. So these are the very surprising results to us at the very beginning. And then we try to Try to look at the potential explanations. Why do they dislike government investment, especially? So we conduct subsequent surveys on some of these, for example, government interference. What are the different channels driving our results? And so I will skip. So this is one of our key results. So we show the dislike is more pronounced, especially the money is from central government relative to local government. So probably the central government, so they will interfere more on these deals. And then in terms of industry distribution, so this is interesting probably for the VCP industry. So we see there's heterogeneity across different sectors. So more towards left, it means the more dislike for government participation. So we show the dislike is more pronounced for the clean tech, for the health, arts, entertainment, and even IT. So there's a lot of variation for the preference in terms of government investment. And then we try to shed light on the channel. Why do they dislike government participation? Some of the reasons come out is due to investment interference. So because if government provide money, so they like to interfere in the investment process. And then furthermore, so we also, there could be other channels, for example, policy uncertainty, as well as lack of professional team. And what could be the advantages? Certain things come out, such as local government support. And also this could reduce funding pressure. So these are the priorities. So they may like government money. And then, so let me summarize our key findings. So essentially in this paper, so we look at the role of government in the VCP industry. So especially given the active role of government, so especially they're shaping entrepreneurship. And also they have implications on the VC investment, even globally. So, and this has been considered the important financing vehicle to carry out these state industrial policies. So we conduct experimental study to estimate demand for government participation. So our results shed light on the limits about state capitalism. So it really depends on the complementarity between the private capital and the government intervention. So now, so to extend our result related to some of my other research is related to big push industrialization with government participation more broadly. So we see is one of these sectors, so government active participates. But however, so I have other piece of paper look at the technology transfer and the industrial development. So from historical context, government also has been very active. So they try to acquire technology from Soviet Union. So this has persistent impact in the long run. So our result is also related, not just speaking about China, it's related to some of these emerging topics about public R&D policy, such as also some of the leading research from the US on the public R&D. So what may be the impact, and also besides China, so other East Asian countries also have successful stories about industrial policies, such as one of my courses work on these spillover effect across input and output linkages, such as in Japan, Korea. There are also other kind of industrial policies scholars look at its impact. So essentially, we hope our research is shedding light on some of the future work on how not just the industrial program, but how industrial program can elicit certain desired economic behaviors. And then we try to learn more about economic mechanism and whether the efficiency implications is intended and how should we fix this market. So I think that's it for my talk. So I'll be brief. Thank you so much.
Thank you so much. And as usual, the slide show will be on the Peterson Institute website later today. You can unshare your screen. And with that, Daniel.
Yes, thank you very much. Thank you very much for this insightful presentation about China. Let me just add a couple of general remarks before we enter in the general discussion. I would talk only about venture capital. Private equity is a much larger concept, sometimes invests in big firms. Venture capital is the part that invests in small firms, startups. And I wanted first of all to emphasize how small it is, but equally how important it might be, because it provides the seeds for small firms that later then become tech giants. From the latest IMF report, one gets that venture capital in the US accounts for about 0.7% of GDP, less than 1%, around 200 billion per year. Now, in Europe, the figure that shocks is that in Europe it's only 0.2% of GDP, which makes about 40 billion US dollars, so about 1/5 of the American figure. And that, I think, is a reflection of the vast difference you see in the vitality of the high-tech investment scenes. If you look at the so-called unicorns, the new startup firms which have 1 billion euro value, they're overwhelmingly the US, some of them Chinese, and others, but very few Europeans. Actually, China doesn't seem to be doing so badly because these IMF figures give China an intensity of venture capital of around 0.3% of GDP, so let's say 50% higher relative to the EU. Now, why this difference? The first question could, of course, be, as Bo said, difference in government policies regarding especially R&D, support for research and development. Actually, when we looked at those numbers, we find that they are very similar in magnitude relative to GDP across the US, Europe, even China, although, as my colleague just said, in China, the difference between government, party, and private sector might be less clear. But it seems to be that in these big three areas, government provides about the same support for basic research and development. So the basic question we in Europe are facing, and I think maybe also China is facing, is why this big difference with the United States? Is it a question of supply or demand? And what do I mean by that? Is it a question of supply of capital looking for risky investments? For example, in the US, some pension funds can invest at least a little bit in venture capital without having to hold more capital. In Europe, you have few investment funds and they're much more strictly regulated. As you know, in Europe, you have a bank-based system with very little equity investment going on overall. That would be one argument. The other argument would be maybe it's the supply of ideas, the supply of small firms that find an economic environment in which they can grow very quickly and therefore make venture capital investment very happy, right? They promise high returns. And I think this is the basic issue for Europe, where my evaluation is that it's mainly a problem of the supply of investment opportunities, not so much of not enough risk capital looking for startups. And that means that government intervention, if there is to be any, shouldn't be so much to say, okay, here's more money to invest in venture capital, but it should much more geared towards making sure that small startups, A, can develop new ideas, and B, then can grow very quickly and be flexible enough in terms of labor markets, market size in Europe especially is a problem, to scale up very quickly. So that, as an overall, I would say in Europe, maybe governments are looking at the wrong problem. They think the governments have to provide more equity, more venture capital funds, whereas they should perhaps be looking more at the conditions under which actually you can create startup or have startups which can grow very quickly and provide venture capital funds with interesting investment opportunities.
Right, and indeed, as Bo mentioned, the session in a way follows up on the one we did 2 months ago with Josh Lerner on his research on venture capital in China. So we really want to dive deeper into this story. Maybe let me start with a question to you, Daniel, on the comparison between Europe and China, which I, for one, find very thought-provoking in that area, because in a way, the US venture capital industry started decades ago, and both Europe and China are trying to catch up from different contexts, of course, but partly with similar instruments. So Bo showed us in one of her first slides this chart from The Economist that suggested that somewhere around, I mean, it depends how you count the others, but say not far from a third of capital invested into VC funds is government controlled in China. And in Europe, we also have a lot of government devices for investment into VC funds. At the European level, there's a European Investment Fund, which is a fund of funds approach managed by the European Investment Bank. In individual countries, there is a variety of devices. As a Frenchman, I know about the BPI France construct, but there are similar things in many other countries. How do you have any sense from your research on how that compares with the numbers that Bo showed us on China, and whether, in a way, there's a similar government intensity in the venture capital industry in Europe, or is it less, or maybe more? How do you view that?
I would say broadly the figures are actually similar. The venture capital arm of the EIB that you mentioned earlier actually prides itself on saying that they provide at least 1/4 of all venture capital funding in Europe, although there's some double counting because sometimes they invest in funds, right? And but if you take the overall number, which I mentioned earlier, of 40 billion per annum of investment, it doesn't take so much to provide 1/4. And I think that is provided more by national institutions. You mentioned the French one, and there are development banks in every big European country. So yes, I think the numbers are relatively similar. I think, however, the way they invest might be a bit different, and I would not expect that a firm which receives a co-investment from governmental source in Europe to gain in terms of political connections or other advantages.
I should mention at that juncture something I should have said earlier in the session, actually, which is that my brother is a venture capital investor, but in his fund there is no national or European government money, so my conflict of interest is relatively restrained from that perspective. Bo, thinking of that, I mean, as Daniel mentioned, there's not an order of magnitude of difference in terms of what you described in China, in terms of government intervention in that market, and what we see in Europe. Does the Chinese government look at the European experience at all, in your experience, or is that completely outside of their mental map?
This is a great question. So from our talk discussion with the policymakers, so I think they do. They learn from Europe and the US, their past experiences, and the government, different ways government can participate and help the startups. So when I talk to the policymakers, so that they are, they actively learn from these past experiences. I think, however, so the way how it was implemented, so that can be very different than those from US and then Europe. So especially, so it delivered more in the Chinese context. So I think the contract, if we look at this contract, so with my current ongoing research, we try to look at it more granularly. So especially for local government, how their contracts differ from the central government. So there's a lot of variations in this, how contract was designed. And so whether this is kind of general, whether we consider as VC investments, so do they are more tolerant for risk, but I think most of these contracts, so I think so far, so there is less tolerance for risk. So so that means the government still want to play safe on most of these kind of projects government have been invested in. So it can be very different, despite the numbers share some consistency. So how it was implemented can be very different. But I think these are interesting facts for us to explore in ongoing research.
Daniel, what's your impression about what Bo just mentioned, which is lesser risk tolerance from government investors, right? I mean, government investors don't necessarily like headlines where it appears that one of their investment has gone bust. We remember Solinka, I think, was the name of this famous green tech firm in the US, where the US government had put money, Barack Obama had heralded them, and then they went nowhere, and it became political football. Do you see that risk aversion in Europe, and how to think about it, given that, as we know, the whole point of venture capital is to, have many companies fail, but enough succeed spectacularly enough that it makes a positive return, right? So how do you see that particular aspect of government behavior in the European context?
That is indeed a major issue. Certainly, no government wants to invest directly in individual enterprises. They always do it through larger financial institutions where you have enough of a cover, so to speak. Some fail, some succeed. But once it's a governmental financial institution, then of course bureaucracy sets in, and it's very difficult for them actually to find the ideas that might succeed, even if there's only 1 in 10% probability that the thing will succeed. What Europe governments have done for a long time is to provide support for SMEs. And so what they thought is, a startup is just a young SMEs. So let's take our SMEs, meaning small and medium-sized enterprises. And therefore, then they have taken their instruments for supporting small and medium-sized enterprises, usually by providing cheap loans instead of investing in equity. And that is one of the biggest problems in Europe in terms of supporting startups, high-risk, high-tech firms, because what they can get mostly is loans for which it's difficult to provide securities, but very little equity capital. And that is, if you want, part of the expression of the risk aversion that you mentioned earlier.
I have more questions, but of course I encourage participants in the audience to use the Q&A tool and ask questions of their own. The session is your session. In terms of the relationship with entrepreneurs, back to you, Bo. As you mentioned, you've done all this field research, but Daniel also mentioned that boundaries between public and private can be blurry in China. There's entrepreneur, the question of whether entrepreneurs have a party affiliation, whether they participate in local, institutions like consultative assemblies and the like. Do you see any trends here, and more generally, even without reference to trends, do you view Chinese entrepreneurs as kind of, maybe the Jack Ma model, being motivated by the dream of startup success? Do you view them as having a more complex mix of motivations? What did you learn from your field study in terms of what animates those entrepreneurs and how they relate to the public space, politics, the party, and government? I mean, we saw how it went for Jack Ma. It's been a complicated journey, but how is that echoed by your experience on the ground?
Yeah, interesting. So when we tell, the government investment, as from the discussion slides, hinges much more on the complementarity between government funding and private money. So based on our surveys and the face-to-face interviews with these kind of VCs and the entrepreneurs, so I think a lot of these tensions going on the decision making. For instance, so their objectives is very different. So for VCs and entrepreneurs, their objective is on profitability. But however, on the government side, so they are leaning towards more on industrial policies or some of these different objectives. So that's why what we see in terms of decision making. So throughout the whole investment process, so there could be misalignment. So this can drive the dislike for government money. So even at beginning of research, so when we interview them, so I think these VCs and entrepreneurs, so they are hesitate in this regard. So, if the way how do they select project can be very different.
So can you give us examples of what a conflict looks like, right? You mentioned dislikes. That means that sometimes there's a misalignment of objectives, and presumably that generates conflict between the entrepreneur and investors. So can you give us just a few anecdotes, without names necessarily, but just of what are the patterns of conflict that you observe concretely?
Okay, so I started with some kind of filler stories on the misalignment side. So, for example, in some local cities, so the government, so they have certain industrial policies. Then they want to attract entrepreneurs to invest in local area. But however, so over time, so I think this is very certain industry specific. So over time, so this policy can change, and then it may no longer match what are the entrepreneur's objective over time, for instance. So therefore, their objective over time. So for example, initially, so they want to invest, for example, semiconductor. Later on, they can switch to something else. So then, because we know, so VCs and entrepreneurs would invest in what their expertise are. So they can be misalignment on the even certain area they want to invest in, on their decision making and etc. There could be some of these tensions going on. And in some governments, such as Hefei, so they are doing pretty good job. Even we visit their Hefei local government. So I think what they did good is probably they are very consistent in terms of their carrying out their local industrial policy. So they were very consistent related to only one sector. So they attract the startup, those local area. So over time, they are able to form clustering of these startups. So some of these are very, very successful. So I heard different stories. So in different through the implementations of these government guided funds. So I think so objective function is very important in whether it can go successful or not, and the consistency.
You seem to be suggesting, but I'm not sure I hear you right, that you observe more instances of that consistency as just what you mentioned in Hefei at the local government levels and the central government level, or do I get that wrong?
More consistent at the local government level.
So how does that match? We get this picture of the Chinese government having long-term strategies and, the 100-year marathon kind of narrative without giving any particular publicity to
that's a very good question. Let me elaborate more. So usually central government, so they have a specific agenda. For example, these are specific areas. For instance, 10 areas we would like to consider it as industrial policies. Then local governments, so they have their choices, which industrial sector they want to focus. So it is a local government, so they choose certain areas. So there are variations such as Hefei, they choose some of these technologies. So they have their university, they choose their advantage, and then they form very consistent industrial policies and try to attract these startups. So it's mainly local government. So they decide what they are going to focus in different periods. So what will be their comparative advantage?
Daniel?
That sounds actually European, what I'm just hearing, in the sense that in Europe we have, of course, all the national governments competing with each other at very different degrees. In the poorer member countries, the governments basically does nothing. But in the more advanced ones, the ones that are already stronger, have a stronger industrial base, a stronger scientific base, mainly the small Nordic countries, there the government is also more active, but it is largely uncoordinated. The European Commission in Brussels would, of course, like to coordinate all this and have a European industrial policy, but it doesn't have, I think, the power the Chinese government has, and also it has very little money. But there is a lot of competition in terms of who provides the most support for venture capital among the larger European countries. Of course, the idea is we would like to compete, we, government, to do this, but once one part of the government has a proposal, the other part, the financial controllers, come in and say, oop, but what happens if you lose money? And so therefore, you have at the same time very strong brakes, which might be less strong in provincial governments in China.
I have a question from Tianle Huang at the Peterson Institute for International Economics for you, Bo. How do local government fiscal challenges impact their participation in venture capital investment processes as you described? And especially given that, I mean, you mentioned Hefei, it's not in the richest province of China. So do we see an impact of slow down in terms of local government investment because of fiscal pressures, or not at all?
Yeah, great question. So indeed, so local fiscal condition can significantly affect the VC investment. So these kind of government guided funds. So that's why what we observed slowdown of these government guided funds. So in the past 5 years or so. Now it affects not just kind of current investment in the VC sector, but also it affects the existing deal. For example, the government have pressure to exit the previous, during the peak period, so they already invested in. Now, right now, I think so the industry. So I talked to them, so they're concerned about whether can they exit, because in China there's not so many channels for these VCs to exit. So so I think that's what some of these key questions. So so we have to think about in the near future. So given the local government capacity has been changing dramatically.
Speaking of exit, yeah, Daniel, sorry.
I just wanted to add to this question, if I may. And maybe you talked about this earlier, but viewed at least from Europe, one thing that concerns, let's say, European Commission also when it looks at imports from China is the very strong role of state-owned banks in providing cheap credits to enterprises. I forgot whether you mentioned that, but I could imagine that a venture capital firm that receives an infusion of funding from a public, let's say, venture capital arm, can it then also count on much more credit from banks, credit on more generous terms?
So essentially for these funds, so mainly so some of these financial institutions, so these in the recent past decades, so they have been active, but most of these are still coming from the local government, so financing vehicles or government guided funds. So these are, as shown from the first slide, so these figures, so these are the biggest proportion. So but for the state-owned banks, so mainly I think so they are from the government mandate, so they are less tolerant for risk. So so probably still they are less active in the VCP market. It's so mainly from the government guided funds, so they are going to invest in the VCP industry. So government imposed restrictions.
You don't see big banks, I don't know, China Construction Banks, ICBC, you don't see them really in the startup space.
Yeah. So they're less active.
Yeah. Another question I have is, all this is so new, right? I mean, many of the government-sponsored investment vehicles that you're talking about have been created basically in the last 10 years, right? I mean, there's not a lot of historical depth in the industry, which in some ways parallels what we see in Europe, but to an even greater extent. Have there been spectacular success stories? Do people talk? I mean, I'm not talking about companies that have been funded in the US, but companies that have been funded by the Chinese venture capital industry in China. Have there been any? What are the kind of role models? What are the stories that everybody's talking about? And do any of these involve government funds in which the local or central government has made a ton of money from a particular investment, or is there basically no example thereof that people would talk about?
Okay, interesting. So there are indeed some of these models. So government talk about, especially for example from Hefei. So I think that's what the role model for the government guided fund. So and then surprising, interesting. So once Hefei, so they have their model of successfully in the past 10 years. So other local government, they're also trying to copy their model. So they come to Hefei and then learn about whether how they can become successful. But it's interesting to see but however whether that's suitable for their own local jurisdiction, that's a question, because each of them, they have different economic conditions. What sector should they pick? So I think so right now, so they try to learn from the Hefei model. But
so can you give us examples of companies that were super successful in Hefei and made a big splash?
So some of these like Jingdongfang, so they have been very successful, like flat screen. So so they have been essentially, I think their technology, so they have been like behind from the Samsung. But with a government guided fund, so they are able to learn, to acquire certain technologies and catch up. So they have been very successful right now. So they're leading in this industry. So I think so. That's considered some of the successful story. And one of the driving force is locally they have their university. So I think they're able to incubate some of the scientific research from the lab to the startups. I think that's some of the ingredients. So helps for phase model.
Daniel, maybe that's a question back to you. I remember you referred to the European Commission's ambition to have a policy. I remember when President Barroso of the European Commission, that's a long time ago, wanted to create a European MIT and had all this discourse about integrating higher education in Europe with entrepreneurial energy. What came out of this, and what do you see as examples of either success stories or policy failures in that space?
What you just mentioned is unfortunately, very good example of a policy failure. The idea was, as you said, to create a European MIT, but since it couldn't be in any one place in Europe, because that would favor one member country, so it was decided to create a distributed European EIT, it's called, European Institute for Innovation and Technology. I think you have never heard about it, nor have I, unless one looks it up. The EU has spent a lot of money on it over the last 10 years, 4 billion in total. And it's basically 50 people in Budapest, in Hungary, who dish out the money all over Europe for some people to get together, do some teaching, some innovation, so it has basically fizzled out. So this is, I think, exactly the argument, the example of what Europe should avoid. It comes back to what both said. The innovation activity is very much concentrated and very often associated, as you mentioned, with top universities, research-based universities. And Europe has no competence formally in terms of universities. The member countries of the European Union are really very jealous about it. And in Germany, for example, the federal government is forbidden to give money to universities because that is the competence of the lenders. So you can imagine the problem we have in having a European Institute of Technology. That was a failure. They learned a bit from that and then created what's called the European Innovation Council, which was supposed to be a copy of the famous DARPA, the Defense Advanced Research Project Agency. Maybe people have heard about DARPA now, that it was credited with basically inventing the internet and many other basic things. And that has worked a little bit. In the sense that it is much smaller, it is a bit more bureaucratic and has much less money than DARPA, but it's not a complete failure. It's starting to provide a substratum of advanced high-tech research and supports some of the leading high-tech firms in Europe. It has existed for 2 years, so it's too early. But so at least after the fact, the Commission has learned from its mistakes. But let me add, if the Commission had been able to act independently, we might have a European Institute of Technology, and it would be in one member country. But that the other member countries couldn't accept. So it's really not the Commission that is at fault, but the collection of member countries whose jealousy against each other makes collective action very difficult.
Is the European Innovation Council also in Budapest?
No, that's a good thing. It is actually nowhere almost. It's a council, it's a vague word for a body which floats between Brussels and Luxembourg. And it basically consists of a collection of people who are formally part of the European Commission, but who independently select proposals on a very competitive basis, much like DARPA does, not exactly, but much like. And it has basically remained under the radar screen of the member countries. It should not get too visible, too prominent, because then the poorer member country will say, how about us? There's no project support in Poland. This cannot be. And but as I said, half success.
So let's hope the fact that we're giving them publicity doesn't spoil their game. I have another question from Qianlei Huang at Peterson for you, Bo. Do you see fads? Do you see waves of hype driving local government investments, like, say this year it's electric vehicles, last year it was semiconductors. I mean, you mentioned the time consistency of Hefei, but when there is also a model like Hefei provides, as you said, then that can lead to everybody trying to do the same thing over capacity. So how do you see this kind of, stop and go cycles and cycles of hype in the Chinese context?
Yep. So, yeah, this is indeed a relevant question, especially today's debate about overcapacity. So actually, I think what we observe now is other local jurisdictions, they try to copy this model. Some of them they make judgment about their own competitive advantage, but others, so they just simply copy and then try to, for example, if you have semiconductor, I'm also going to have semiconductors. So this may lead to, for example, overcapacity to a certain extent, but I think we need to further evaluate whether there is indeed overcapacity, whether that can be justified by local economic conditions, indeed whether they are competing too much, right? They are producing the exactly same thing. So I think these are the very important questions. So we are also trying to give some answer. So in our current research, so we try to explore local government industrial policies. We collect data on each of these local government policies. We collect their contract. We try to compare, to which extent they are very similar, to which extent they are different, to help answer some of these questions. That's a great question for us to think.
Supplementary question, which is about the situations where there is no government investment. So do you come across, I'm sorry if that question is kind of uninformed, but do you come across venture capital funds and startups where the government is completely absent and basically that conform to the kind of idealized Silicon Valley model? Or is that basically not happening in China? How does it look from your field research?
Okay. So from my field research, they are indeed. So in the past, they are firm just like a US model. So you just rely on private equity, you can be successful, especially I think in the past in the entertainment, in the consumer, and these are different industries, they have been very successful. Some of them, they are already listed in the US. So they rely on private capital. There are. So the question is, so how can we, so if we hold everything else constant, right? So if, whether government money can be more successful or less successful. This is an empirical question, so it's also challenging to answer. But we hope so we can, in the subsequent research, we can explore this question deeper, especially what are the different conditions, right? So, is this due to government or private money, or is due to other conditions? So that this may affect the successfulness of these startups.
Do you also see such pure private sector startup successes in tech, or is tech always with a government component in China?
Oh, there are private capital investing in tech. So just purely private capital there, not just the government investment. The government investment is only has been peaking, so about 2015, 2016. So prior to that, it's mostly private capital.
Oh, sorry, I thought you had a reaction maybe to the previous question.
Can I just add one thing? I think one has to distinguish between the venture capital giving to young fledgling firms, and usually we're talking about a couple of million US dollars worth to get it going, and then what's called later second and third round, perhaps a bit more. That's very different from a provincial government saying, okay, I give you 200 million to create a new, to build a new factory for batteries, or a new factory for electrical cars. And the concerns in Europe are, of course, about this overinvestment that comes when different provincial and local governments put these hundreds of millions in the same sector, because that is the future, and then creating much overcapacity. I think I wouldn't call that no longer venture capital, but that's more the industrial policy at the governmental level. In Europe, when we talk about venture capital, I think for the European institutions and also for BPI in France that you mentioned, usually they give, as I said, a couple of million to get a company started so that it has a market, and then perhaps a bit more later, and then they get out. But they don't provide hundreds of millions or billions to build new big factories.
On this question of orders of magnitude, what kind of range you observe in your research? I mean, the kind of investment with government sponsorship, do they go from the very small to the very large, or is it the kind of clustering around certain, levels of support?
Okay, so in my sample, right? So actually, what we observe, mostly government concentrated on these large deals. So I think this is different than from Europe. So they may target these medium-sized or small size firms. So in China, so they target these large companies. So even so in the early stage, so with certain size, for example, especially in the tech sector, like semiconductor or other sectors. So with certain scale, so the government, so it satisfies government criteria. So certain industries, certain scale, that is related to the industrial policy. So they're more likely going to receive the government guided fund financing.
So you mentioned Hefei, for example, as a success story. What is the typical ticket? What is the typical investment that the Hefei fund or funds that you studied make in early stage companies?
So typically, I think most of these are clusters around these kind of digital or more like flat screens. So
I mean, in terms of amount of investment in a typical deal, early stage deal, how much would they put? How much money per investment?
Okay, so let's put it this way. So the government, so usually for certain deals, so most of these government, they invest so about between 20 to 30% of the money. So the rest of this capital from this private capital. So usually, so the government say, okay, I will get started, so I will invest about.
My question, sorry, I wasn't clear, is absolute amount. Are we talking about in dollar equivalent, a few $1 million, a few tens of $1 million, less than that? What's the kind of order of magnitude that they typically do for a first investment in an early stage company?
Okay, so if in absolute number, so it's more like between $1 to $5 million dollars something. So that's what to get started. So yeah.
Okay.
And
So
then,
similar
yeah.
to what Daniel was referring to. Unfortunately, we're at the hour. I could continue for hours as usual, but I want to thank very heartfully our two speakers. I learned a lot. I think this comparison between China and Europe should not be pushed too far, of course, given the differences in the systems, but it is also very enlightening, at least to me. Our next session will be in 2 weeks' time on Tuesday, the 25th of June. We'll talk about the financial situation of Ukraine with Maria Repko, who is in Kiev, and Elina Rybakova at the Peterson Institute and Bruegel and Kiev School of Economics. But again, I want to say many thanks to Professor Li Bo and Daniel Gros for their fantastic comments today, and looking forward to more discussions about the Chinese innovation scene, on which there is so much to learn from. Thank you very much, and have a great rest of your day.
Thank you so much.
Bye-bye.
Thank you so much.